In 2008, the Federal Reserve watched something happen that had never happened before in recorded American history. Household net worth, the combined total of every asset owned by every American family, fell by $11 trillion in a single year. 18% of all household wealth in the United States. Gone. In 12 months. The largest destruction of wealth ever recorded. And that wasn't even the full damage. From peak to trough, total household net worth collapsed by $16 trillion. The U.S. Treasury Department's assessment put the final lost household wealth at $19.2 trillion when all effects were measured. Nearly $20 trillion wiped from the balance sheets of ordinary American families, the worst financial crisis since the Great Depression. That was 2008. Total U.S. household net worth stood at $67 trillion. The stock market was worth $19 trillion. The financial system, for all its flaws, was a fraction of the size it is today. Here's the number that should stop you cold. As of mid-2025, total U.S. household net worth stood at $176.3 trillion, according to the Federal Reserve. Of that, $61.1 trillion is in corporate equities, stocks. Another $49.3 trillion is in real estate. The system is not twice as large as it was in 2008. It is nearly 3 times as large. When this system corrects, the overvaluation, leverage, credit stress, and fragility will compress asset prices. The magnitude of wealth destruction will not be 11 trillion. It will not be 16 trillion. The math of a system 3 times larger, experiencing a correction comparable in percentage terms, produces a number that most people haven't yet been willing to say out loud. $20 trillion. Not a speculative figure, not a worst-case fantasy. A mathematically grounded consequence of the system's size, the degree of current overvaluation, and the historical precedent of what happens when these conditions have converged before. Here is exactly how $20 trillion gets erased, and why the conditions that make it possible are not approaching. They are already present. The architecture of the $20 trillion number. Let's build this carefully. This figure is a structure, a sum of 4 distinct categories of wealth destruction. Each category is independently devastating, all 4 compounding each other. The first, equity market losses. The U.S. stock market capitalization stood at $69 trillion as of January 1st, 2026. American households hold $61.1 trillion in corporate equities, including 401ks, IRAs, and mutual funds. Now apply historical precedent. In the 2000 to 2002 dot-com bust, the S&P 500 fell 49%. In the 2007 to 2009 financial crisis, it fell 57%. These are significant historical magnitudes. Based on current KP ratios, a 40% decline in equity values would erase approximately $24.4 trillion. Roughly $17 to $18 trillion falls directly on household balance sheets that own those equities. Even a more moderate 30% decline erases $18.3 trillion in total market cap. Household equity holdings would fall by approximately $13 trillion. The second category, real estate losses. American households hold $49.3 trillion in real estate. Housing markets are under structural stress in 2026. Mortgage rates remain elevated. Housing affordability has deteriorated to the worst level in 40 years. The Housing Affordability Index is near multi-decade lows. Commercial real estate is already in open crisis. CMBS office delinquency rates are at 12.34%, exceeding 2008 crisis levels. In the 2008 crisis, residential real estate lost $6 trillion in value, a 30% decline. In the dot-com bust, housing held up. But in 2026, housing is more overvalued than in 2007. The median home price to income ratio exceeds a 6 in many markets, compared to 4.6 at the 2006 peak. A 15% decline in residential real estate values erases approximately $7.4 trillion from household balance sheets. The third category, private wealth and retirement account destruction. The total value of 401k, plans, IRAs, and defined contribution retirement accounts in the U.S. now exceeds $13 trillion in direct retirement holdings. Pension funds add another $6 trillion to $7 trillion in equity-correlated assets. These accounts are predominantly invested in equity and bond funds. When the equity market declines 30% to 40%, retirement accounts decline proportionally. In 2008, retirement accounts alone lost $3.4 trillion in a single year. In 2026, with retirement account balances roughly 150% higher than they were in 2008. The average 401k balance now stands at $315,920 per Empower. A comparable percentage decline would produce losses of $8 trillion to $9 trillion across retirement accounts alone. The fourth category, the wealth effect reversal. This is the most insidious and least discussed dimension of wealth destruction in a serious market correction. When household wealth rises, 401k balances grow, and home equity increases, consumers spend more. Economists call this the wealth effect. The Federal Reserve estimates that every $1 increase in household wealth generates approximately 0.05 to $0.07. This translates to additional annual consumer spending. This works in reverse with devastating efficiency. When household wealth falls by $20 trillion, consumer spending contracts by $1 trillion to $1.4 trillion annually. Consumer spending is 70% of U.S. GDP. A $1 trillion decline in consumer spending is a 4% to 5% contraction in the economic foundation of the entire economy. This is not a stock market story. This is a Main Street story. Businesses close, jobs disappear, wages stagnate. The recession that the stock market correction predicts becomes the recession that the wealth effect reversal creates. Add these four categories: equity losses, real estate losses, retirement account losses, and the wealth effect reversal. And the $20 trillion figure is not an exaggeration. It is a conservative aggregation of the most documented and most historically grounded mechanisms of wealth destruction in modern economics. Why the financial system is larger and more fragile than in 2008. The critical question is not whether these mechanisms are real. They are documented by the Federal Reserve, the IMF, and the U.S. Treasury, and decades of academic research. The critical question is, why would a correction of this magnitude happen now? The answer comes in three parts. The first part is valuation. The U.S. stock market is, by almost every metric, the most expensive it has ever been, relative to fundamental economic reality. The Buffett indicator stands at 221%. Warren Buffett said when it approaches 200%, investors are playing with fire. It has never been at 221% before. Not in the dot-com bubble, not before 2008. Never. The Shiller-Cape ratio is at 39.8. This reading has appeared in only 26 months out of 829 total months since records began in 1957. In every previous instance, when the Cape crossed 39, the subsequent 3-year return for the S&P 500 averaged negative 30%. The forward price-to-earnings ratio of the S&P 500 sits at 22.2, well above both the 5-year average of 20.0 and the 10-year average of 18.8. Historical data from J.P. Morgan shows that at this starting valuation, the S&P 500's average return over the subsequent 10 years has been approximately 1% annualized, accounting for inflation. Not 10%, not 7%, 1%. This is not a market priced for normal outcomes. This is a market priced for perfection. And perfection is not the condition the underlying economy currently reflects. The second part is leverage. The amount of borrowed money embedded in today's financial system has no modern precedent. Margin debt, money borrowed by investors to buy stocks, sat at $1.21 trillion as of late 2025, representing 3.98% of GDP, the highest level in recorded history. U.S. corporate debt stands at $13.7 trillion, much of it issued at rates that made sense when borrowing was cheap in 2020 and 2021, and now needs to be refinanced at significantly higher current rates. Household debt totals $20.5 trillion per the Federal Reserve, with credit card debt alone at $1 to 33 trillion ends, carrying average APRs of 22.83%. Government debt sits at $38.4 trillion, consuming nearly $1 trillion per year just in interest payments. Every layer of this leverage works the same way in a downturn. Asset prices fall. Margin calls go out. Investors are forced to sell to meet margin calls. Forced selling drives prices lower. Lower prices trigger more margin calls. The cascade accelerates. This is not theoretical. It is the documented mechanism of every leveraged crash in financial history, from 1929 to 1987 to 2000 to 2008. The third part is concentration. The S&P 500 has never been as concentrated in a small number of stocks as it is today. The Magnificent Seven, Microsoft, Apple, Nvidia, Amazon, Meta, Alphabet, and Tesla represent 32.6% of the entire S&P 500's market capitalization. 1/3 of the world's most important equity index in 7 companies. Concentration is a risk multiplier. When the broad market corrects, the most heavily weighted stocks fall the most because they are the most owned, the most margined, and the most subject to forced selling when redemptions hit. In 2026, all 7 Magnificent Seven stocks are already negative year to date. Microsoft is down 17.6%. Tesla is down 10.4%. The basket collectively has shed 5.1%, while the rest of the market scrambled to compensate. If the Magnificent Seven decline 40%, which is well within historical precedent for overvalued technology leaders during a correction, and less severe than the 78% Nasdaq decline of 2000 to 2002. They alone destroy more than $15 trillion in market capitalization from 7 companies, whose shares are held in virtually every 401k index fund, every passive ETF, every institutional equity portfolio in the world. The concentration that made the bull market feel unstoppable is the same concentration that will make the correction feel catastrophic. The domino sequence, how $20 trillion disappears. The mechanism of this wealth destruction is not simultaneous across all asset classes. It happens in a sequence. Understanding this sequence is critical to understanding why it becomes so difficult to escape once it begins. It starts in the equity market. The most overvalued assets reprice first. Technology stocks, the primary engine of the bull market, correct first and hardest. Their valuations rest on optimistic assumptions about AI-driven revenue growth. The Magnificent Seven's drawdown accelerates. Passive index funds fall proportionally. 32.6% of the S&P 500 is concentrated in 7 stocks. The passive investor who thought they were diversified discovers they were not. Within days of an accelerating equity decline, margin calls begin. The $1.21 trillion in outstanding margin debt doesn't just sit there, it requires collateral. When collateral values fall, brokerages automatically liquidate positions to cover. The forced selling adds to the decline. The decline triggers more margin calls. The volume of forced liquidation overwhelms normal market liquidity. Spreads widen. Execution becomes difficult. Prices move more dramatically than fundamental news would justify. This is not a crash. This is a cascade, and it moves faster than most investors can react. The consumer wealth effect begins working in reverse almost immediately. Household balance sheets, now at $176.3 trillion in net worth, begin to contract. Spending decisions premised on record-high brokerage and retirement balances get revised. The discretionary purchase gets postponed, the vacation gets canceled, the home renovation gets put on hold. Consumer spending, which represents 70% of GDP, begins its contraction. Quietly, one household at a time. The domino sequence, how $20 trillion disappears. The mechanism of the $20 trillion wealth destruction is not simultaneous across all asset classes. It happens in a sequence. And understanding the sequence is critical to understanding why it becomes so difficult to escape once it begins. It starts in the equity market. The most overvalued assets reprice first. Technology stocks, primary engine of the bull market, whose valuations rest on optimistic assumptions about AI-driven revenue growth, correct first and hardest. The Magnificent Seven's drawdown, already underway, accelerates. Passive index funds fall proportionally, and because 32.6% of the S&P 500 is now concentrated in 7 stocks, the passive investor who thought they were diversified discovers they were not. Within days of an accelerating equity decline, margin calls begin. The $1.21 trillion in outstanding margin debt doesn't just sit there. It requires collateral. When collateral values fall, brokerages automatically liquidate positions to cover. The forced selling adds to the decline. The decline triggers more margin calls. The volume of forced liquidation overwhelms normal market liquidity. Spreads widen. Execution becomes difficult. Prices move more dramatically than the fundamental news would seem to justify. This is not a crash. This is a cascade, and it moves faster than most investors can react. The consumer wealth effect begins working in reverse almost immediately. Household balance sheets, which the Federal Reserve's data shows are now at $176.3 trillion in net worth, the highest ever recorded, begin to contract. Spending decisions that were premised on brokerage accounts and retirement balances at record highs get revised. The discretionary purchase gets postponed, the vacation gets canceled, the home renovation gets put on hold. Consumer spending, which represents 70% of GDP, begins its contraction. Quietly, one household at a time. Corporate earnings follow the consumer. Revenue shortfalls emerge. The companies that borrowed aggressively to fund AI capital expenditure. Amazon at $200 billion annually, Alphabet at $185 billion, face the question of how to service that debt when revenue growth disappoints. Earnings guidance gets cut. Stock prices fall further. The cycle between corporate weakness and stock price declines becomes self-reinforcing. The labor market, already showing job losses through early 2026, deteriorates further. Companies carrying excess staff, anticipating AI gains, reverse course, layoffs accelerate. Unemployment rises from 4.4% towards 6%, then 7%. Each percentage point increase means 1.6 million Americans lose income. Their spending disappears from the economy, their mortgage payments become at risk, their credit card balances become uncollectible. Real estate, supported by wealth effect and employment security, cracks. Not because of some new crisis, simply because buyers willing to pay 6 times income for a home when their 401k was high and job secure are no longer able. Demand falls, inventory builds, prices decline. The $49.3 trillion in household real estate wealth begins to shrink. And underneath all of this, the private credit system, or the $2 trillion shadow banking infrastructure, continues to show stress. It replaced traditional bank lending for an entire generation of corporate borrowers. Middle market companies depending on private credit for operating capital find their credit lines reduced or repriced. Some fail. The failures cascade through supply chains. This is not a prediction of an imaginary future. Every one of these mechanisms is already visible in early stage form. In the data that exists right now in March 2026, The dominoes are not standing in a line waiting to be pushed. They are already falling. The first ones have already tipped. The question is not whether the sequence will begin. It is how far down the line the fall will travel before some intervention interrupts it. The historical precedent that makes $20 trillion conservative. Here is the number that puts $20 trillion in context. The U.S. Treasury's assessment of the 2008 financial crisis placed total lost household wealth at $19.2 trillion. The St. Louis Federal Reserve's calculation put the loss at $17 trillion in real terms, a 26% decline from peak. The Federal Reserve Board documented that household net worth fell from $62.7 trillion to $51.5 trillion in 2008 alone, an $11.2 trillion decline in a single year. That was a system of $62.7 trillion. Today, the system is $176.3 trillion, nearly 3 times larger. If the 2026 correction produces percentage losses comparable to 2008, a 26% real decline in total household net worth. The dollar amount of destruction is $45 trillion. If it produces losses comparable to the dot-com bust at 20%, a shallower correction, the destruction is $35 trillion. 20 trillion is not a catastrophic extreme scenario. It represents a 10% to 12% decline in total household net worth, less than half the percentage loss of 2008, less than the percentage loss of the dot-com bust. What makes $20 trillion feel extreme is the sheer size of the number in absolute terms, a function of the fact that the financial system has been inflated through 3 cycles of quantitative easing, through zero interest rate policy, through pandemic-era stimulus, through AI-fueled speculation, to a scale that has no historical precedent. The percentage loss required to produce $20 trillion in wealth destruction is modest by historical standards. The dollar magnitude is not. That is the core of the argument. The system is so large, so concentrated, and so overvalued that even a moderate correction by historical standards produces a wealth destruction event that is, in absolute dollar terms, larger than anything that has come before. The only question that matters. There are 2 ways to respond to this analysis. The first response? Dismiss it. Label it doom and gloom. Note that the stock market always recovers. Note that no one can predict the future. Go back to checking your brokerage account and assume that because the screen hasn't shown catastrophe yet, catastrophe is not coming. This is the response most people will have. It is the response that most people had in 2006, in 2007, in early 2008. The response that felt comfortable and reasonable right up until it became catastrophically wrong. The second response, take the data seriously, not with panic. Panic is as useless as denial, but with the kind of clear-eyed, evidence-based analysis that the data deserves. The evidence says the U.S. stock market is at 221% of GDP, the highest ratio in history. The Shiller CAPE at 39.8 predicts average 3-year returns of negative 30%. Household equity holdings of $61.1 trillion sit at valuations that have only been seen in 26 months out of 829 in recorded history. And in every prior instance, produced severe multi-year losses. The Federal Reserve's own documentation shows that the last serious correction in a system that was then worth $67 trillion destroyed $16 to $19 trillion in household wealth. Today's system is worth $176.3 trillion. The magnitude of potential wealth destruction is not speculative. It is the mathematical product of the size of the system, the degree of overvaluation, and the historical precedent of what has happened every time these conditions have appeared before. $20 trillion is not a number designed to frighten you. It is the number that the math produces when you take the current system seriously. The question, the only one that matters now, is whether you will take the current system seriously, before the number stops being theoretical.